Hello! This video is a detailed walkthrough on how to file corporate taxes in Canada. The June 30th filing deadline is approaching for those businesses with a December 31st year end. So I thought I'd walk you through step by step on the three key components of a corporate tax return. Now, this video will probably cover at least 80% of businesses in Canada. And I hope by watching this video today, it could save you a lot of hours of headache or even thousands of dollars on an accountant if you were to do it yourself. All I ask for in return is that you hit that like button, subscribe, and turn on the notification bell. If you're new here, my name is Alice and I'm a chartered professional accountant. I specialized in audit and taxation when I was an articling student. Now, there are three key components to the corporate tax return. There's the first 9 pages, which is the actual tax return itself. When I worked in the industry, we used to call this the jacket. Then there's all the supporting schedules. Okay, Schedule 1, Schedule 2, Schedule 3, 4. Not all schedules will apply to you. I'm gonna go over all of the common schedules that will apply to at least 80% of the companies in Canada. And I'm gonna leave detailed timestamps of all of the different schedules. The third component of the tax return is the GIFI, also known as the financial statements. So there's the G100 or the balance sheet and the G125, the income statement. So let's hop into my computer. I highly recommend using a filing software when it comes to your T2 tax return. And the best software to use is one of the certified programs that are listed directly on the CRA website. So pretty much all of these softwares here will do a very similar thing, which is give you the ability to complete and file a tax return. And I highly recommend picking one that has the internet filing option, because that makes things so much easier if you could just file electronically and directly on your computer. Otherwise, you have to do things like print off the tax return, go mail it. It's 2024 and it's just much easier to do everything electronically now. Almost all of these softwares function in a similar way. The only difference is user interface. Some of them will be more user-friendly than others. So for example, something like QuickBooks Online, TurboTax, I know, even though I've never used them personally, both of these softwares must be very user-friendly because TurboTax and QuickBooks Online is designed to be so. So I highly recommend those two as a good 2 options to look at if you're just getting started. I've used FutureTax before in the past. It works really well, but you do need to know what you're doing when it comes to putting in the numbers into the returns, and it can be a little bit confusing if you're doing this for the first time. Same thing with T2 Express. T2 Express is going to be the one that I'm using in this program. I'm actually using it for the first time myself, so it'll be interesting to see. Just make sure you check the technical specs and the compatibility of each of these softwares, depending on whether you have Windows computer or a Mac. The gold standard for professionals is corporate tax prep. So tax prep is what most firms use these days. But I believe that for tax prep, it's only a commercial license. For business owners that are trying to self-file or do this yourself, I recommend TurboTax and QuickBooks Online. So the first component to the tax return is the first 9 pages. This is what we call the jacket in industry. These 9 pages basically is the tax return. The first page here has some basic information about the company. The second page are the schedules that are relevant to the company based on the transactions that happened in the year. And then down here, you will see taxable income. So this is where the actual calculations begin. Now, if you are using a filing software, which is what I recommend, then these numbers will pull automatically from the other schedules that you are inputting. So you actually don't need to put in anything manually into these sections. They should be calculating automatically, assuming that you've done the schedules correctly and put all the numbers in that you need to. For example, this one here comes from Schedule 1. These numbers here come from Schedule 2. This number comes from Schedule 3. These come from Schedule 4 if it's applicable to you. The small business deduction is available to CCPCs in Canada. If you are an eligible CCPC, your first $500,000 of taxable income is taxed at a preferential rate, depending on the province that you live in, 11 to 13%. Next is general tax rate reduction, which is just another calculation that's applicable to CCPCs. So if a CCPC has taxable income in excess of $500,000, or it's not a CCPC at all, then this section would apply. These next couple sections here can get a little more complicated in principle. But the TLDR of these next few pages is based on the principle of integration in Canada. So there's 2 key ideas. The Canadian tax system is designed to prevent double taxation. This means that income received by a shareholder paid in the way of a dividend would be the same as if they were to pay themselves a salary. The second idea is to prevent the use of sheltering investments inside corporations. So that's why investment income, also known as aggregate investment income, is taxed at the highest rates in Canada. Any tax paid on investments by a corporation will be accumulated in the RDTOH account, and it will be refundable to the shareholder through a dividend refund. So in a nutshell, if a company owns rental property and stocks and pays tax on those assets, then these sections will apply. Okay, refundable Part 1 tax, RDTOH, and dividend refund. Next section is Part 1 tax. So corporations pay Part 1 tax on their taxable incomes. So this will apply to pretty much all companies that have taxable income. And again, assuming you're using a filing software, the filing software will calculate how much the actual Part 1 tax payable is. On page 9 is basically a summary of all taxes payable, which is a combination of all these sorts of taxes. And if you're watching this video today, most likely for most corporations, it's Part 1 or Part 4 tax that's payable. If you had any installments that you paid during the year, this is where they should show up. And as a result, you should see the refund or the balance owing from these calculations. And the bottom part here is for certification. So, certified officer of the company would sign here, as well as any contact persons for the return down here. So I have a sample company here. I just made up the balance sheet and the income statement, but I'm going to walk you through how to fill out the first page if you're doing this for the first time. Now, if you're using a filing software, a lot of this basic information should carry over from the previous year. But if you're filing for the first time, this is what it should look like. Even if you're filing for the second time or third time, or you've been doing this for years and years, still good to double check these numbers and all the information that you put in. So business number here, that's your 9-digit business number. By the way, if you guys ever see this RC means corporate tax, RT means GST, and RP stands for payroll. Depending on your company, you may have those 3 accounts, but if you're ever wondering what the letters mean, that's what they stand for. Corporation name is just name of the company. There are 3 sections for addresses down here. This used to confuse me a lot, but this is basically the address of your head office. So if you had a physical location, a physical office, this is where, address of head office is. And then this is the mailing address. Usually it would be the same as the address of the head office, but say you want the mail sent to your house rather than your physical office, this is where it would be different. And then location of books and records. If it's not the same as your primary place of office, for example, if it's your notary or your lawyer or your accountant's office, then that's what you can put here. For type of corporation, there's a couple of different legal classifications in Canada for how to classify your company. Okay, so it could be a CCPC, other private, public, a corporation controlled by a public corporation, or other. Those are the 5 categories. So I recommend that you do reading here if you're not sure what type of company that you have. For the most part, most privately held small businesses in Canada are usually CCPCs. You can see the criteria here. Private company that was resident in Canada, not controlled by a non-resident person. Okay, so assuming that you as the business owner are Canadian, live in Canada and pay Canadian taxes, not controlled by a public company. So for head office, let's say if your address did change from last year to this year, make sure you check off this box accordingly, because what happens is if you don't check off this box or you forget to, then the CRA will send the mail to the wrong address and might have the wrong address on file. So this is the time to update if you moved in the year or changed locations or whatever. And we're just going to say that head office equals mailing address here. Let's just say that ABC Company is a CCPC and we did not change the corporation type during the year. To which tax year does this return apply? So let's say for ABC Company, the year end is December 31st. So it would be January 1st to December 31st. If you had a September 30th year end, then this would be, October 1st to September 30th. If you had a September 30th year end. But let's just say that this company has a December 31st year end. Acquisition of control is a tax concept. So by definition, if the ownership of the shares have changed during the year, then there could potentially be an acquisition of control. That's what you would check here. If you don't know what this means, it probably doesn't apply to you. But if you do know what this means, you probably would have had to get lawyers involved in the process. Deemed year end, no. Professional corporation that is a member of a partnership, no. If this is your first year of filing after incorporation, this is where you would check yes. If not, no. Similar to acquisition of control, amalgamation is also a tax concept. You can read more about it on the CRA website of what constitute as an amalgamation. They have some reading and some definitions. It's pretty lengthy, but basically in a nutshell, two companies have to combine because it's an amalgamation in order for an amalgamation to happen. Wind up of a subsidiary under Section 88, no. Final tax year before amalgamation, we're just going to say all of these are no. And non-resident claiming tax exemption under income tax treaty, we're going to say no. This next page here allows you to select all of the relevant schedules. So I will be going over in detail all of the relevant schedules for ABC company. And if you're using a filing software, they should tick off the boxes as long as you're filling out the schedules as you go along. IFRS reporting standards is a financial reporting standard for public companies. So that's going to say no. Corporation inactive, no. This down here is where you type in what the business is actually selling. So like the actual product sold. So if you sold consulting services, then you would type in consulting services. All right. If you sold widgets and toys, that's where you type widgets and toys. If you have multiple streams of income, maybe you sell, I don't know, accounting services, tax services, something like that. It just needs to be an estimate. It doesn't have to be 100% accurate. As it says here, approximate percentage. Immigrate or emigrate? No. CRA has some very defined rules when it comes to residency of a corporation. Same with residency of individuals. Residency is definitely a big subject in the topic of tax. But, earlier when there was that question about residency, resident of Canada, what I should have shown is this document here by the CRA, which you can do reading on if you are not sure whether your company is a resident. And similarly for immigration and emigration, you can find the reading notes here as well. And that's pretty much all we have to fill out for now. The only other thing I'm going to put in is, depending on your filing software, there might be a schedule for you to put in installments, but you want to make sure that any installments that you put here are showing up here. Very important. Otherwise, you would have done all the work and accidentally remit the wrong amount to the government. So the installment part is crucial. So now we're moving on to the second component of filing a corporate tax return, which is the financial statements. So this is where we actually start to do the tax return itself. It all starts with the financial statements. I'm going to start with the balance sheet, and then I'm going to do the income statement. But the balance sheet here I've made up for ABC company, and I'm using T2 Express to file this return. Again, any tax filing software does a very similar thing. And if you're using a tax filing software, typically for the second year, it will carry forward the numbers that you used in the previous year. So if this is your first year filing, then last year will be 0, and you actually have to do an opening balance sheet and file that along with this. We're not going to do that for this video. I'm just going to show you what the ending balance sheet looks like for December 31st. So keep in mind that this isn't a perfect tax return scenario, just to be very, very, very technically clear. But I'm going to show you what it would look like to put in this balance sheet in here. So depending on your situation, you might have numbers in the last year section. So let's start off by punching in all these numbers. So we're just going to line everything up according to this balance sheet. So you see cash here is $10,000. AR is $3,000. Prepaids is $3,000. Inventory $30,000, and then I'm going to land, PP&E, I'm going to assume that, we had a gross of $60,000 in purchases and $10,000 of accumulated depreciation. Because how PPE works is that it's the cost minus the depreciation equals the net book value, right? So let's just say the cost was $60K. And for accounting purposes, we took $10,000 of depreciation, which is how we ended up with $50,000 as per this line item right here. So that's where I would put 60,000 here and then 10,000 here for a net of 50. And the system, you don't have to put a negative number here. The system automatically knows to subtract this. So the system knows this is a negative value. Next we have land. Oh, we got land already. Next we have marketable securities. I'm going to assume that these are, Canadian stocks that pay dividends. Just put them here. For common stock, put $1, and for retained earnings, we're gonna assume last year's retained earning is $265,999. Now, if I double check my total assets, I see 296 here. Agree that to total assets here, perfect. That checks out. Okay, so now we're gonna punch in the liabilities. We have $5,000 of AP, $20,000 of loan payable. Accrued liabilities we are going to put here. Okay, now let's move on to the income statement. So we have sales here of 200 grand. Cost of goods sold, I'm going to put into purchases, assuming this is an inventory-based company. There is a more proper way to do this when you actually reconcile the inventory balance. For the purposes of this video and just a quick demonstration, I just want to get the cost of goods sold number to 100,000 so that we can have a gross margin, gross profit of 100 grand, which agrees to this. Income from investments. We have $500 of interest income. We have $6,000 of portfolio dividends received from Canadian companies. And then we also sold some stock during the year and earned $5,000. So we're going to put that in realized gain and losses. For fixed costs, we're going to plug in all of these numbers. So we have advertising and promotion, amortization, interest on bank charges, interest on long-term debt, meals and entertainment is $1,000. Office expenses. Where are office expenses? Down here, found it. Repairs and maintenance. Salaries, property taxes, travel, 1,000, utilities, 1,000, vehicle expenses. You can see here that my net income for accounting purposes is $29,350, which is $2,000 off from this. So I know that something is off, and my thought process, I'm trying to look for if something doesn't align up, is to, go back to the income side. I know that I've got the gross margin right, so that must be correct. Total operating expenses is $80,150, but I have $82,150 here. So I know something is off. And, if I kind of go backwards, I see here I've got this one, got this one, got this one. I'm just missing this one. So you can see here, $29,350, $29,350. That's perfect. That's what we want. So we know that net income is correct. So once you're done putting in the income statement and the balance sheet, we're going to move on to the actual schedules. The first schedule is Schedule 1, net income for tax purposes. So Schedule 1 is basically a reconciliation between net income for accounting purposes and net income for tax purposes. Now there is a distinction, a very important distinction between accounting income and tax income. ELI 5 explanation, we have accounting income here. The Canadian government and the law stipulates that we have to make some adjustments to this number to get to a net income for tax purposes. So that's basically what the Schedule 1 here is. There are a couple of different, line items that go under this schedule. And if done correctly in punching in the balance sheet and the income statement, you typically don't have to manually punch in anything into Schedule 1. So that's why it's important to start with the income statement first, because a lot of these numbers would have automatically populated based on what you had punched into the income statement. For example, amortization of tangible assets here came directly from this line item right here, 2,000, right? That's where the 2,000 comes from. Non-deductible meals and entertainment expenses, that also came from right here, the 50% portion. Schedule 3 is for filling out any dividends received in the year. So for ABC Company, I had $6,000 of portfolio dividends. And in this example, we're gonna say that it came from 4 different stocks, totaling $1,500 each. So what we're gonna do is we're just gonna type them into Schedule 3, 1,500 each. And these are eligible dividends. So we gotta make sure that we punch it in to both columns. What happens on eligible dividends is that Part 4 tax will be applicable. So that's what this calculation here is in column J. And how you know that this has been done correctly is if you go back into the T2 general tax return, and you can see here Part 4 tax payable is being pulled from Schedule 3. Schedule 4 is the loss and continuity schedule. So this may or may not apply to all businesses. It's used to basically calculate the history of losses that's been suffered by the corporation since its existence. Okay, so this could be non-capital losses, which is what you see here. Capital losses, so for example, if you sold stock last year and you lost money on that stock, you would have had a capital loss, and you would be able to carry forward that loss and apply it in the current year if you had a capital gain. And in that scenario would reduce your taxes owed on capital gains in this year. So losses can be carried backwards or they can be carried forwards. The CRA has different rules on non-capital, capital, farm losses, and limited partnership losses. So depending on the type of loss, there are a certain number of years and rules around those losses. Schedule 6 is the gain and loss schedule for any capital assets that you sold in the year. So if you sold any stocks during the year, that's considered capital property. That's where this would go. In our example up here, we said that ABC Company sold stocks, earned $5,000 from it. Here, I have the breakdown of where those numbers came from. So let's say that we sold 100 shares of TD Bank. Fair market value is $14,000, cost base is $15,000, proceeds $16,000, and the cost base is $10,000. You can see here total capital gains is $5,000 and the 50% portion is $2,500. And how you know that it's been done correctly is that number will then carry forward into the Schedule 1 taxable capital gains. So the purpose of Schedule 7 is to identify what portion of income is considered investment income and what is considered active business income. The schedule will automatically pull the eligible portion of taxable capital gains from Schedule 6 here. Okay, we had the 2,500 or the 5,000 times 50%, which gets pulled into here. And all we're going to do is punch in property income, which is the income that we have from interest right here. So aggregate investment income is property income plus taxable capital gains. So 50% of the capital gains amount. That's the calculation that you see here. And the total aggregate investment income is taxed at 50%. So the last page of Schedule 7, you will be able to see income eligible for the small business deduction, which is active business income. So $26,350, and that is basically net income for tax purposes less any property income. That's income that we had put into the first page right here. So this $26,350 is going to flow back into the T2 tax return, and that's what we are going to be paying tax on, or what the tax calculation is going to be based on. So as you can see here, $26,350 eligible for the small business deduction. Part 1 tax is calculated on this amount. Schedule 8 is for capital assets. Now for accounting purposes, we depreciate capital assets with a couple different methods. For tax purposes, we take something called CCA. Now I highly recommend reading up on the different capital asset classes that the Canadian government has set out. You can read more about them on their website. The most common ones, Class 1, buildings, Class 8, furniture, and it's sort of like a catch-all class. Class 10 is for cars. Class 10.1 is for cars that are over a certain dollar amount. Class 43 is for machinery and equipment. If you're curious, then definitely check out this page to search for what class the property is in. Schedule 8 is basically a continuity schedule. So it starts with the class number here. So if you had some furniture on hand and it fell into Class 8, then that's where you put the class number here. UCC stands for undepreciated capital cost. So if we acquired the asset in the current year, then UCC would be 0. But let's say that we had purchased equipment for $10,000. You can see here that the schedule will automatically apply the half-year rule as well as the 20% CCA rate, which means that for tax purposes, you can write off $1,000 with this $10,000 purchase. And you can see here once you put in the CCA and fill out Schedule 8, and that's what will show up here on Schedule 1. Next, I want to talk about some of the disclosure statements that may or may not be applicable to you, but nonetheless, I'm going to explain them all. Schedule 9 has to do with related and associated corporations. So the CRA, Income Tax Act, has a handful of different rules on what is considered an associated company and what is considered a related company. So I highly recommend you do some reading if you feel like this may apply to you. Their website has a lot of different examples on what is considered related and what is considered associated. If this is not something you're comfortable at concluding yourself, then definitely reach out to a professional in this case. Schedule 11 is another disclosure schedule. It just requires you to state any transactions that the company had with its shareholders or employees during the year. So for example, if you took a shareholder loan from the company, then you can put that down into here. Schedule 23 is a schedule to allocate the business limit in Canada. So in Canada, associated CCPCs have to share the $500,000 business limit. So going back to the associated corporation definitions, companies that are associated have to share the $500,000 business limit. And Schedule 23 is how you would allocate that $500,000 business limit. So for example, if you as a shareholder owned two companies wholly 100% and they were both CCPCs, those two companies would be associated and they would have to share the $500,000 limit. If one of those companies did not turn a profit and one of those companies was profitable, then what you can do on this schedule is allocate $0 to the company that was not profitable because that company is not paying any taxes, and then allocate the $500,000 to the company that was making money. So this is where you allocate the business limit, and you would put in the business number of the associated corporation, which basically discloses to the CRA how you want to use that $500,000 limit. Schedule 50 is to disclose shareholder information. So all companies in Canada have shareholders. Schedule 50 is applicable to you if you are a private corporation and if any shareholder owns 10% or more of your common or preferred shares. This is where you just disclose the name, your social insurance number, your business or partnership number. That would only apply if the shareholder is a business. If the shareholder is an owner, then you would type in, social insurance number here. If the owner is a trust, then you type in the trust number here. And let's just say that you own 100% of the company. That's how you would disclose ownership on Schedule 50. The last disclosure section is Schedule 141. This is the notes checklist. This is just a couple of yes or no questions that you have to answer, that you're required to answer, but don't forget these. So here, a person primarily involved with financial statement is a person more than 50% involved in preparing the financial statement. So if you own the business and you prepare the tax return, then you would tick yes. Does this person have a accounting professional designation? Yes or no? Are you connected with the corporation? Whoever is involved with filing the taxes, if it's not yourself, just has to do this disclosure section. Where notes to the financial statements prepared, you just check yes or no. Subsequent events, usually it's no. Most of these situations will probably no for most people, for most businesses, but if there is a contingent liability or if there is revaluation or material events after the fact, which is what we call subsequent events, then you would just disclose it down here. So these are just yes or no questions, depending on the nature of the business and the transactions that happened in the year, as well as after the year end. So let's talk quickly about the compliance rules in Canada. Majority of businesses have a December 31st year end, meaning that their year end aligns with the calendar year end. But businesses are required to file tax returns 6 months after their year end. So if you have a December 31st year end, you would have to file by June 30th. If you have a September 30th year end, you're required to file by March 31st. Now, where it gets confusing is the difference between your filing deadline and when taxes are actually due, because technically taxes are due before your return is due. If you anticipate that you have to pay taxes, then it's good to set yourself up to pay for installments, or it's a good idea to do tax planning ahead of the fact, remit an estimate to the CRA, and then any difference can be either paid or refunded when you actually file your tax return in June. If you overestimate and over-remit, the CRA will refund you the difference. And if you underestimate and under-remit, then you would have to pay interest on any balance owing.